Hey, welcome back to Everything Money. We're glad you joined us again. Today, we're going to look at Apple, obviously an amazing company. We'll use our exclusive software to look at the financials and fundamentals behind this company, the numbers, what they make, their shares, their debt, what they're doing to you as a stockholder. And you will learn how to analyze a company by looking at these metrics and then transfer this into the stock price and see if the stock price is in line. If you like trading Apple, Trader Mo will show you the charts on a daily and weekly basis, and we will get into all of this right now. But first, who are we? We welcome you in. I'm Seth. I bring your normal person questions to a couple wealthy guys that manage over $100 million in real estate, bonds, stocks, all the jargon you love. They are going to tell us how we should be investing our money, my money. I'm eagerly learning from them on a daily basis, and you can be too. Stay tuned. We'll show you our software. We'll show you everything. Right now, I introduce you to Paul Gabriel, my love.
Hello, everyone. First off, follow us on Instagram. We have a new Everything Money Instagram account. It's awesome, and you can also follow us personally. Okay, so we're doing Apple today. So here's the Everything Money software. More on that later, but we go to the 8 Pillars tab. I type in Apple. It pops up. We go right to it.
Now, they have earnings coming here, right? Mo's earnings today or
this afternoon, 4:30.
This afternoon. So
this is like a Super Bowl.
Look at the Apple. This is the all-time chart for Apple. In 1998, it was 15 cents. 1997. I mean, this is incredible. When I was in college, when we graduated from college, Seth.
Yes.
What was it at? Essentially 30 cents. So if we bought it back then, did I tell you to buy it back then?
Forrest Gump bought it back
That's
then.
right.
As you
He's
know.
like, we over.
What were you saying, Mo?
There's a guy in Cleveland that I know. He bought Apple at $20, and he's never sold it to this day.
How many shares?
But when was that?
Oh, back in the 90s, whatever it
So
was.
it wasn't even $20. Like split adjusted, it's like 15 cents.
Probably.
That's what I mean. Like that's what I mean. So anyhow, guys,
That's a lot of money.
So to start, Apple's market cap $2.5 trillion. I think it's the most valuable company in the world. Correct. Now, our first metric, our first pillar of our 8 pillar software is the 5-year PE. We're looking at the 5-year earnings average based on the market cap. We want it to be less than 22.5. It's a little expensive at 41, so that's an X. But don't worry about that quite yet. Our goal is to look at all 8 pillars and then figure out, is this company growing enough to justify a high PE? Next pillar. 5-year return on invested capital. We want that to be over 9%. Seth, do you see this number?
I do. It's
30.2%. This means they do a great job of investing the capital within the business. Because remember, a business can generate, business gets money from either debt or equity from its shareholders, right? They can issue more shares to get money to go invest, or they can issue debt, or they can use the equity from the profits of the business. So they do a great job of reinvesting their capital. So far we have 1 X and 1 check. Now, Seth, our beautiful dividend yield here.
Oh, how
0.6%.
Oh, my God.
The very key here, guys, is
Look at that.
when you're looking at a dividend yield, most people think that a dividend is safe and secure. But what we do here on this channel with our exclusive software, we make it very easy. I look at dividends paid of $14.34 billion. I go 2 and 3 lines up. 2 lines up is their 5-year average free cash flow of $67 billion, and last year they did $95 billion in free cash flow. So what this says to me is this bad Magella is very safe. I'm not worried about them paying this dividend because a lot of companies will try to get you in with a high dividend because they know you're not going to go and research can they afford it or not. So this company can easily afford it. All right, so our next pillar is income growth. We want to see 5-year income growth. So we go to our software.
Stay tuned, by the way. We have not mentioned the ticker price at all. We will get to that later because at the moment, it doesn't matter. This company needs to be making money. They need to be doing the right things financially to reward you as a shareholder. Go ahead,
Absolutely.
Paul.
So we pull up the income statement, very easy click. We go 5 years ago, $223 billion in revenue. Last year, $347. Massive check. But look at this, Seth. I want to make sure you know there was a big jump from the previous year. I think it was COVID related, people staying home, probably buying a lot of devices for their home, etc. So the question is this sustainable? I don't know. Pillar number 4.
This is profit growth over the past 5 years.
Correct. So we just scroll down a little bit. 46.65 to 86.8 billion. Again, a big jump from the previous year, but the point is it's still a check mark. Now, pillar number 5 is a silent killer. It's probably the most overlooked metric in all of investing. So many people out there do not understand this. What this is shares outstanding. Guys, it's very important that when you're looking at a company, you want to make sure they're not diluting you as an owner. If they're issuing more shares out there, it's probably because the stock is expensive. and they want to give all the other suckers out there more shares, that's hurting you as an investor because it's giving you a smaller piece of the pie every time they issue more shares. So we want a company that's taking shares away because you're going to keep the number of shares you have. So you're getting more and more of that pie as they decrease the number of shares outstanding they have. So we scroll to the very bottom of the income statement. We look 5 years ago, 20.78 down to 16.63. They're buying shares back like crazy.
Yep.
So they're taking their excess cash, which is a ton of it, and they're saying, hey, let's reward the investors who've stuck with us. Let's buy back shares and give them a bigger piece of the pie because it'll drive up the earnings per share for them. So far, I believe we have 1X and 3 checks.
Okay, Paul, pillar number 6 is total long-term liabilities, basically their debts, divided by 5-year free cash flow average. We want this number under 5. Explain it to the folks at home.
So we go back to our main page of our exclusive Everything Money software. We have it very easily written right here, the 5-year average free cash flow. I multiply this number by 5, and that is $337.5 billion. Is that accurate? 67.5 times 5. Uncle Seth's going to do the math.
337.5. You got that in your head?
I did. Jeez. So what we want now is we want to go to the balance sheet. We want the long-term liabilities to be under this number. So very easily, scroll up to the top, balance sheet, scroll to the bottom. Their long-term liabilities are 157, so less than half that number. So they can pay off all their long-term liabilities with a mere 2.5 years, not even, of their 5-year average free cash flow. That's awesome, guys. Why does that matter? Is a company more likely to stay in business or not stay in business with less debt? We want companies that are managing their debt loads very well. Their job is to make money by growing the business, not by using financial shenanigans and debt to increase leverage and all that stuff. We don't want that. We want smart companies that are using their debt properly.
Mo, is this the greatest company in America?
I personally think it's the greatest company in the world.
Mo is an Apple fanboy.
I mean, this is incredible what they do. Let me talk about the revenue real quick. So in this third quarter, they're expected to put out about $90 billion for revenue. Amazon, they sell iPhones, iPads, computers, watches, subscriptions. Amazon sells everything.
Yeah,
and it's going to be $111 billion.
Everything.
Everything.
Including a lot of our products.
Isn't
Paul.
that crazy?
Yes. And they don't get the big margins that Apple gets. Apple gets huge margins.
It's incredible.
Pillar number 7 is free cash flow growth. We've mentioned it a number of times. This is the big mamma jamma, and we want to make sure their free cash is growing, Paul, of course, so they can pay the dividend, make acquisitions, buy back shares, yada, yada.
Yeah, so free cash flow is harder to manipulate than earnings. And I'm not saying manipulate necessarily in a negative way, which does happen. But the IRS and SEC has rules on earnings that they have to report things a certain way. Cash flow is cash in, cash out. Can it be manipulated? Yes, but not as much. So we go to the top of the Everything Money exclusive software. We click the cash flow statement. Cash from operations less your capital expenditures. Now, what we do here for you on our exclusive software, I added this line to the cash flow statement. You will not find this added to the cash flow statement on any other software. Other software will put it, but somewhere else in the site that's confusing. We add this line, 53.2 to 94.7, check mark. Now, our final metric. We want to come up with some sort of market cap to pay for the company. This isn't set in stone. Historically, the average free cash flow should be about 15 to 1. What we want to do, though, is we're looking at 5-year average, so we want to pay a little bit more than that. So I take the 5-year average free cash flow of 67.5, I multiply it by 20, and I get 135 billion or so. That's not right. Yes, it is. Sorry, 1.35 trillion. 1.35 trillion, because it was 60. So the market cap was actually 2.5 trillion. So that's an X. Now, guys, I want to repeat. This doesn't mean you avoid the stock, because remember, this cash flow is growing very fast. If a company is growing very fast, you should pay a higher multiple. We've had 8-pillar stocks that are growing so slow that when we go look at it, it doesn't make sense. So if all this work is too much for you, guess what we have here? The 8 pillars tab right here.
Check, please.
Look at this, Seth. What are our 2 metrics that are the X's?
Just the price.
Just the valuation. So guys, we created this software because we were doing this on my own software that was $500 a month. So people were saying, hey, how can we get software that does this for us so we don't have to wait for your video? So we created the software. We put a lot of work into it. And what it now provides, though, for people is we provide exclusive daily content, 2 or 3 videos a day, only for our users. You get access to Seth, Mo, and I. There's a chat with over 6,000 people that you can talk to. So if you feel alone in investing, you have other people to talk to every day about your investment ideas to bounce things off of, okay? This is all available for only 90 cents per day. 90 cents per day. It's less than a crappy cup of coffee. All this for you. If you can just increase your returns by 1 or 2% a year, it'll make you hundreds of thousands, if not millions of dollars extra in retirement over a 34-year period. This is a no-brainer. If you're serious about investing, this is the software for you. It does all this for you. And you get news, and we haven't even done the most important part, the stock analyzer tool.
Let's get to that right now, Paul. Paul's going to put in some data for you to analyze the stock moving forward in the future. Mo, before he does that, and before we get to your trading, what do you expect with earnings coming out just today?
I think that earnings are going to be fine. I think the forward-looking guidance is what's going to maybe hurt them a little bit due to the iPhone sales that they're not being able to deliver. And this is why I say that earnings is a total crapshoot. When you look at what Ford just came in with, Ford came in with revenue down 5% and the stock price is up 10%. And the reason is because they're saying forward-looking guidance, everything's looking really rosy into the future. So it's all analyst expectations. I think that their earnings are going to be fine. The forward-looking guidance could hurt them going into the future.
The stock analyzer tool lets you project and make assumptions moving forward about what a company might make and then what you should be paying for this stock right now. If you pay too much now and it underperforms, you will overpay maybe for the rest of time, like with some stocks, Paul. So we want to make sure we're paying a great price for this.
Yeah, so every investment is the present value of all future cash flow. So we added this discount cash flow and discount earnings model that says, hey, what's revenue going to do over the next number of years? So the first thing we do is we select number of years of analysis, 1 to 20. Then we select number of assumptions. So you can select 1 assumption, 2 assumptions, or 3. For an established business, I usually pick 2 assumptions. Apple's very established. Then we go below. It shows us our 1, 5, and 10-year growth numbers on all these things. I put my assumptions, okay? Now, guys, you're seeing the snippet. Everything is based on assumptions. We don't know the future. We can only guess. I try to be conservative. I look at Apple going, is it likely that they grow at previous growth rates? Probably not. Now, for some of you out there, I'm going to go high and low on these. Share buybacks, gross profit margin, free cash flow margin, et cetera, and multiples. I go to the bottom. One of the most important parts is my desired annual return. Guys, I put in 12.5%. The reason being is...
This is a big key, Paul. I don't think people buy stocks with a thought process of I need to make a certain return or I shouldn't be buying this, like buying a house to flip or something of that nature.
Absolutely. And that's all it is, guys. This is still an investment. You have to still determine how much money you want to make. If you invest in an ETF over long periods of time that match the market, you make about 10%. So to pick an individual stock, to me, give yourself a little bit more margin there, 12.5%. And this is also how you put in a margin of safety. The bigger the return, the higher the margin of safety. So I put these numbers in. I do a very simple thing. I hit the analyze button. Now is the first time we care about stock price, because stock price is merely a reflection of how many shares they have. If you look at Berkshire Hathaway, their share price is 450,000 or whatever the number is right now. It's because they have a lot less shares outstanding. But it's a much less valuable company than Apple, but their share price is 430,000 because they don't have as many shares out. Hit the analyze button. So guys, based on my highest assumptions, the stock is a buy all day. So if you believe these high assumptions right here, which could very well be normal assumptions, 10% revenue growth for 10 years, 5% buying back shares, et cetera, all the way down, you're buying the stock all day. If you believe my low assumptions, you have to wait till 80 or 90 bucks. It's probably somewhere in the middle. Mm-hmm. So I think it's still expensive because it's probably more like, well, actually, it might be the fair price for it. If your assumptions are somewhere in the middle here, then actually maybe it's a pretty reasonable buy at this price. Now, I remember we did some analysis before. I think we came up 120 when we did a little more thorough analysis for us to buy the company. But we pretend to be more conservative because I have 8 or 9 businesses upstairs. I have a lot of things. I have a lot of real estate. I have a lot of things going. So I would tend to be more conservative. So maybe Apple is a buy right now, just based on your assumptions. But again, get our software, put your own assumptions in, and you can determine how much you're going to pay for Apple.
Mo, are people trading? Folks, do not trade those stocks around earnings. Anything can happen, as you discussed with Ford, Mo. Give us the deets on Apple.
Yep. So to me, Apple is strictly a long-term play. It's very hard. I mean, you can go and day trade this one on a 15-minute chart, but swing trading in this one is rather difficult. This is where I would play this one. This is a long-term chart. So actually, we caught this whole one. We got a little bit burned in here too with everything just turned on us because the whole market turned on us. But with that being said, we are almost at a sweet spot reversal. As a matter of fact, we had one yesterday, and then I think this light volume over the past couple of days waiting for earnings kind of switched that back. So what I'm hoping for is we get a little bump in earnings today, and this thing turns up and makes a sweet spot reversal, and we can run this thing back up to that 157 all-time high number, whatever it is. This is a really good stock to trade from a long-term perspective and a day trading perspective. If you want to learn more about day trading, come and join me in the Bid and Ask Nation for $1.50 more per day. You can get access to all of the Everything Money software that Paul just talked about, and you can come to the Bid and Ask Nation. You get the Trading 101 series, the Employed Trader series, which I spoke about, my monthly seminars, which one I'm doing next Saturday, November 6th, all for $1.50 more per day. Come join me in the Bid and Ask Nation.
Final take, Paul, on Apple.
I like it. The company is great. They have a high return on invested capital. I know Berkshire likes it. For me personally, I'm waiting a little bit for it to go down. But for somebody who wants a good company at a good price, I mean, maybe this is the right price for it. I'm not. Here's the point. I'm not turned off completely. As long as you believe these assumptions, I think you're going to do pretty well with Apple if you believe those assumptions I made.
And the one thing I don't think that people factor in enough is they haven't even started with their subscription business.
Yeah.
I mean, they have a long way to go with that one. I made a few good minutes on it last week, and there's a lot to be said about subscriptions.
All right, great.
That's our take. Join the community below. Click on the links. We will see you in the next video. Fondle the thumbs up on the way out. And thanks for watching.